Hello everyone, this is Phil Yaeger and welcome to Accounting for Income Taxes in Financial Accounting. Now, I want to give you a review on this, and you have to remember that income tax expense on the income statement is made up of income tax expense current and income tax expense deferred. These two equal your total income tax expense that goes on the income statement. Now, first of all right, let's talk about the calculation of the first one. Income tax expense current. Well, this is based on taking your taxable income times your current tax rate. And that will give you a debit to income tax expense current and a credit to income taxes payable. Now, the thing you have to remember is this. They're going to probably give you the book income, all right, and you're going to have to reconcile to the taxable income. And the way you're going to do that is you have to know, all right, what items, first of all items of income are included in book income, all right? Interest on muni bonds, all right? Another one would be, for example, insurance proceeds from a life insurance policy, all right? But if you had to go from book income to taxable income, all right, you would have to take out the interest income on municipal bonds from the book income. You would have to subtract the life insurance proceeds from the book income to arrive at taxable income. And in turn, what do? Well, all expenses are deductible to arrive at book income. So therefore, any non-taxable expenses that are not deductible on the tax return, any expenses, all right, that are not deductible on the tax return, but which were deducted on the books, have to be added back to the book income to get our taxable income. Remember that. Now, one other thing with this income tax expense current, income taxes payable. A lot of times, companies pay estimated taxes. Now, they may ask you this. If a company paid estimated taxes, all right, what is our income tax expense current? Well, if it's asking for the income tax expense current, it's still just the taxable income times the current tax rate. But if they ask you for the income taxes payable, what do? Well, you take your taxable income times the current tax rate, all right, and subtract from the income tax expense any estimated tax payments that you paid in advance, and that will equal the income taxes payable. So estimated taxes only affect how much you actually owe the government. It only affects the income taxes payable. Now, the blueprint in our books, which is page 2L2, and by the way, all right, if you don't have our books, no big problem. But I want to talk about a valuation allowance account. Now, let me explain to you what a valuation allowance account is, all right? But, well, I'm not going to talk about it immediately, because now let's talk about the second component of income tax expense deferred. And this has to do with timing differences. All right. Now, there's an asset and liability approach when it comes to accounting for income taxes. All right. When we're dealing with timing differences. And timing differences is just a fancy word which means what? All right. We may take one expense on the books. All right. Like, for example, depreciation. We'll take accelerated depreciation on the tax return, straight line on the books. Now, as long as we hold that asset for its total economic life, all right, initially, the accelerated depreciation will give you more income tax expense on the tax return. But if you use straight line on the books, straight line is going to give you less depreciation than the accelerated on the tax return. But about halfway through the life of the asset, our straight line depreciation starts to become higher than accelerated. But over the total economic life, at the end, the accelerated will equal the straight line. So That's called a timing difference. This time, all right, accelerated may exceed straight line, all right. If we use accelerated on a tax return, obviously, all right, we're going to have additionally lower taxable income than book, but eventually our taxable income will be higher than book. It's just a timing difference. But eventually all the depreciation expense will be the same for tax and book purposes. All right, now let's assume it's the year 12/31, all right, 2019. All right, and on our tax return, we are using accelerated depreciation, and our depreciation, because accelerated on tax return, is $300,000. All right, but all right, on our books, because we're using straight line, the depreciation is only $150,000. Now, the way you do this information for accounting for income taxes is this. All right, you have to determine what the timing difference is. Well, in this case, if we're using accelerated depreciation on the tax return and straight line on the books, all right, what's going to happen? At the end of 12/31/19, all right, our taxable income will be lower than our book income by $150. All right, now we make this assumption. If in the current year our taxable income is going to be lower than book income, when this reverses itself, what's going to happen in the future? Well, taxable income will be higher than book income in the future because of the reversal. And when you have a timing difference in the current year, which will cause taxable income to be higher than book income in the future, this is called a future taxable amount. Now, if you take future taxable amounts and you multiply them by either the future tax rate, when it's going to reverse itself, if known, or if you don't know the future tax rates, you multiply it by the current rate. But that will give you, all right, future taxable amounts times the current rate, or the future rates if you know it, all right, will give you what we call a deferred tax liability. All right, now, you're going to record that deferred tax liability at the end of 2019, all right, and what you're going to do is you're going to credit deferred tax liability, whatever it is, and the plug is to income tax expense deferred. Now, at the end of every year, you're going to do this. The income tax expense deferred is closed out to the income statement, but the deferred tax liability account stays open, all right, and each year you will adjust it. So if the end of 2020, our deferred tax liability balance should be higher than what we set up at the end of 19, then in 2020, you'll make an entry to increase the deferred tax liability, credit deferred tax liability, and you'll debit income tax expense deferred. All right, now, the next thing is, what happens if 2019, we have this situation? All right, we sell merchandise and we sell products, okay? And we also guarantee that if anything happens to those products, we'll repair them, all right? Which means we're giving warranties. Now, please remember that, all right, from an accounting standpoint, if you know, based on prior experience, what your estimated warranty expense will be in the future, for accounting purposes, you have to record it, all right? So, from a book standpoint, if you know your warranty expense for the future, based on prior year calculations, all right, you have to record warranty expense on the books. Let's assume it's $200,000. We're just coming up with a number. But from a tax purposes, you cannot deduct warranty expense until you actually incur the costs. So if you don't have a warranty expense, all right, for this year, all right, what's happening? Well, let's assume that we have book warranty expense of $200,000 and 0 on the tax return. Well, we can make this statement based on this. Taxable income is going to be higher than book income by $200,000. Isn't that true? Taxable income is going to be higher than book income by $200,000 because we have a deduction on the books but nothing on the tax return. Now, this will reverse itself. And we don't care when it reverses itself. It reverses itself after 2019. Now, when this reverses itself, what's going to happen? On the tax return, we will have a deduction of $200,000, but we already took it on the books. So, when this reverses itself, taxable income will be lower than book income by $200,000. Now, when taxable income in the future is lower than book income because of a timing difference, this is called a future deductible amount. That's what this $200,000 is. Now, remember, future deductible amounts times either the future tax rates or the current tax rates, if known, all right, will give you a deferred tax asset. Now, at the end of 19, we have to make an entry, all right? Let's assume the deferred tax asset comes out to $100,000. That's too high. All right, comes out to $60,000. $40,000. Let's make it 40. All right, we'll debit deferred tax asset, $40,000. And now the plug to the entry is to income tax expense deferred for $40,000. All right, now deferred tax asset is like a future receivable. So I expect a future receivable from the government because my taxable income is going to be lower in the future than book. So that means I'll get a future refund. It's just like an asset, a refund. And if it's a future receivable, that's going to reduce my future income tax expense. Now, please note, when it comes to a valuation allowance account, this is what you have to remember. All right, if you set up a deferred tax asset at the end of 2019, you are saying at the end of 19, there's a real good chance that I'm going to collect $40,000 from the government in the future. But, all right, if there's a greater than 50% chance that you will not collect it in the future, you have to set up a valuation allowance account. So please remember, all right, this is a blueprint. Recall the criteria for recognizing or adjusting a valuation allowance account for a deferred tax asset. Remember, if there's more likely than or greater than a 50% chance that a deferred tax asset will not reverse itself in the future, an allowance must be set up. All right, now what's the journal entry for the allowance account? And the answer is this. All right, you will credit, this is an asset, you will credit a valuation allowance account for the amount that you feel will not reverse itself, all right, and you will debit income tax expense deferred. Why deferred and not current? Because this is a timing difference, all right? This may occur in the future. There's a greater than 50% chance. Debit income tax expense deferred, credit valuation allowance account. The valuation allowance account is what? It's a contra account to deferred tax asset. All right, now please remember, deferred tax assets and deferred tax liabilities are now shown on the balance sheet as non-current items. They're both non-current. Deferred tax assets are non-current assets. Deferred tax liabilities are non-current liabilities. They're non-current liabilities. All right? That's the deal. Now, remember, what causes the difference between book income and taxable income is two types of differences. One, timing differences, which are called what? All right? Temporary differences. Temporary differences are timing differences. And also, book income and taxable income, the difference is caused by what we call, all right, permanent differences. Now, a permanent difference would be this. That would be like interest on municipal bonds, all right? Interest on municipal bonds is book income. But it's never going to reverse itself because interest on municipal bonds will never be taxable. So if you have something that's on the books but will never occur on the tax return, that's called a permanent difference. Remember that. A permanent difference. Okay, now, let's read something here. I want to read to you, all right? As a result of the Tax Cuts and Jobs Act, corporate tax liability may not be readily determinable on the last day of the period. So, Accounting Standard 2018-05 requires that a company record provisional amounts if reasonable estimates can be determined. Then, these amounts can be adjusted when more information is available, prepared, or analyzed. If a reasonable estimate cannot be determined of the tax liability, the company should wait to record the tax effect until a reasonable estimate can be determined. All right? ASU 2018-02, it states, if income tax effects from the Tax Cuts and Jobs Act are stranded in accumulated other comprehensive income, since current GAAP requires tax rate adjustments to flow through to current earnings, these amounts will be reclassified to retained earnings. All right? This is, let me repeat it, ASU 2018, all right, -05. And also, when it comes to calculating income tax expense current, income taxes payable, all right, also income tax expense deferred, all right, deferred income taxes payable, you have to know to prepare the journal entries, all right, and to record the tax provisions in the financial statements. I think you know that. All right, now, the next thing. Let's see what else. I want to make sure I'm going over this. All right, now, we discussed deferred tax assets, deferred tax liabilities. Now, let's talk about a net operating loss carry forward. All right, now remember, corporations that have net operating losses can only carry them forward effective for tax years January 2nd, 2018 and thereafter. All right, so you no longer have net operating loss carry backs, all right, from 2018 thereon. All right, so please remember, a net operating loss carry forward is always considered a future deductible amount. All right, net operating loss carry forwards are always future deductible amounts. So, you're going to multiply them by either the current rate or the rate that will be in effect when you expect these to be tax deductible, all right? And now we'll give you, obviously, future deductible amounts give you a what? Deferred tax asset. So you're going to debit deferred tax asset, and you'll credit what? Income tax expense deferred. Remember that, okay? Now, also, the equity method is a timing difference. All right, let me show you what I'm talking about here. If you own 20% or more interest in another company, you have to show your investment at equity. And the entries are this, all right? Let's assume the company you invested in has net income of $100,000 and they paid dividends of $30,000. And you own 20%. Well, when you own 20% or more, there's a presumption you can exercise significant influence. And if you own more than 50%, you have control. Either way, you must carry your investment in equity. All right, so let's make the entries here. 20% of net income is what? $20,000. Debit investment for $20,000, and credit an income statement account called equity and earnings. $20,000. All right. Now, also, all right, investment, $20,000 credit. All right. When you receive a dividend, you debit cash and you credit the investment account. So, 20% of 30 is $6,000. Credit investment of $6,000. All right. Now, from a tax standpoint, all right, this equity and earnings is book income only. But the amount of dividends that are paid of that, $6,020, this is going to be taxable income. And this is book income. Now, what you do here is this, all right? If you receive future earnings, which you expect to do, all right, because this is a future dividend, all right, you're going to take the future dividend received deduction. Okay? Now, let's assume that, in case you can't remember, all right? By the way, these are not the actual dividend received deductions. All right? But let's assume that, all right, if you own 20%, all right, and they tell you the dividend received deduction is 80%, all right? That's not what the real rate is now under the Tax Cuts and Jobs Act. All right? But you're not taking taxes here. You're taking financial accounting. So they'll tell you, based on 20% ownership in a company, all right, they'll tell you what the dividend received deduction is. Okay? All right. Let's assume it's 80%. All right. Now this is what's going to happen. All right. This $6,000 is the amount of dividends received, and that's from the earnings of 20. So therefore, please remember this. All right. You are anticipating that you're going to receive future earnings of $14,000. All the remaining earnings will be paid out to the investors. They paid 6 of the 20, so the future earnings are $14,000. These are future earnings. Now, this is not future taxable amount, because if these are future dividends you're going to receive, all right, these are eligible for the dividend received deduction. Now let's assume the dividend received deduction is 80% of the $14,000. All right? So you take the $14,000 times 0.8, all right, and you can exclude $11,200 of these dividends, all right, when you actually receive them in the future. So, all right, this will be future earnings of, if I could only, let me see here, it should be 20, all right. All right, so the amount in the future that will be taxable will be future taxable amount of $2,800. So I got the future earnings 14. The dividend received deduction is 80% of that, 11.2. All right, so therefore, after you exclude the dividends not subject to taxation, all right, you're going to be taxed in the future on $2,800. Now, you multiply this by the future rate, if you know it, or the current rate, if you don't know it. Now, let's assume the current rate, all right, because you're going to make me president, all right, the future rate's going to be 10%. Okay? God, I'm going to bankrupt the country. All right? So, I'm going to pay $280 in taxes. So, what do you have to do, all right, in the current year? Because you're going to owe taxes, you're going to debit what? All right, now remember, this is a timing difference. So you're going to debit what? Let's do the credit first. You're going to credit deferred taxes payable, $280, and you'll debit income tax expense deferred for $280. All right, $280. Okay? All right, so basically, all right, that's what you have to know for accounting for income taxes, really. All right, that's it. Nothing more, nothing less, okay? All right, ladies and gentlemen, thank you very much. I hope this helped you, and we'll see you again real soon.